Am I audible? Am I audible? ఇక్కడ I think some problem is there. I think you have to play. Yes, I will select Purnima. Purnima, I will give you a questions, theory questions, important questions. First of all, let me know, am I audible? Yes, I will select Purnima. Purnima, I will give you a questions, theory questions. Naeem, thank you. I think volume is fine. Let me know whether my voice is clear or not. If my voice is clear, I'm going to continue. Voice is bit low. So do not compare my voice with Verma sir voice or Ravi sir voice. Okay, my voice is a little bit low only. My point is, am I audible or not? Am I audible or not? So that is my question. So do not compare my voice with Verma sir, Rajesh sir, or any other faculty. No doubt my voice is little bit low. So am I audible or not? Let me know so that I can start the session. Right, sir, please share PDF in the group. So and share Telegram group also. Done. So first of all, before starting FM and BDA, let us see before starting the concepts, let us see the paper pattern. I think you already know the paper pattern. Let us see the paper pattern. So first question, they will ask you theory. First question, they will ask you theory, and one question from 2A, generally 2A question will be asked from financial institutions or instruments. Financial institutions and instruments, 2A. 2B, they will be asking question from BDA, business data analytics, 2B. 3A, ratios. 3B, they will be asking you either ratios or a cash flow statement or a fund flow statement. Cash flow statement or a fund flow statement. 4A, they will be asking you ratios, and 4B, cost of a capital. Cost of a capital. 5A, 5B. So they will be asking you capital budgeting. Capital budgeting. And next, 1 minute voice is low. So 5A and 5B, they will be asking you 5A and 5B, capital budgeting. 6A and 6B, working capital management. 7A and 7B. So they will be asking you a capital structure and leverages, or capital structure and dividend decisions, or leverages and dividend decisions. 8A and 8B, they will be asking questions from business data analytics. So eighth question will be theory. Eighth question completely theory. Eighth question. So voice is low, still low. Right. Now, let me know. Now, my voice is okay or not? Please tell me. Okay, done. Done, done, done. Thank you. This Venki Venkat, let's go. So, paper pattern 2A, already I have discussed. Again, I am repeating it. 2A. So, 2A theory question, they will ask you from financial institution and instruments. 2B, business data analytics. 3A, ratios. And 3B. So, they might ask you question from ratios, cash flow statement, or a fund flow statement. 4A, ratios. 4B, cost of a capital. 5A and 5B, capital budgeting. 6A and 6B, working capital management. 7A and 7B, they will ask a question from capital structure plus leverages, or leverages plus dividend decisions, or capital structure plus dividend decisions. And 8A and 8B, they will be asking a theory question from business data analytics. This is the paper pattern. Now, my suggestion, you better focus on 7A, 7B, 7A and 7B, because there are less concepts to learn. 6A and 6B, 6A and 6B, that is working capital management. 4A and 4B, 3A and 3B. So in this war room, our main focus will be on 3A, 3B, 4A, 4B, 6A, 6B, 7A, 7B. On these questions, our focus would be there. And I will be giving guess questions for BDA, Business Data Analytics. Okay. So you can ask me any doubt afterwards. I mean, let me start the class. So later on, if you want to ask any question, you can ask me. Okay. Now my voice is it clear? My voice is it clear now? Let me know. My voice is it clear? Done. So cost of a capital. So let us start with cost of a capital. So cost of a capital means a minimum return required by the company to meet the expectation of the investors. Minimum return required by the company to meet the expectation of the investors. So cost of a capital, cost of a capital. So cost of a capital KD. KD is equal to I into 1 minus tax rate divided by NP. So this is for irredeemable debt. This is for irredeemable debt. However, if it is redeemable debt, KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Yes, Chandrika, you can watch this marathon. Okay. So KD, cost of a debt for a redeemable I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. So NP, here NP is equal to issue price minus flotation cost. Issue price minus flotation cost. Flotation cost means cost of issue of a debt. Cost of a issue of a debt. Cost of raising the capital is called as a flotation cost. NP is equal to issue price. NP, net proceeds, is equal to issue price minus flotation cost. Okay. So now, so let me recall again the cost of a capital definition. Cost of a capital means minimum return required by the company to meet the expectation of the investors. Minimum return to meet the expectation. Cost of a capital. Simply, we can say cost of a capital means an expectation. So what does the debenture holder expect? A debenture holder will expect interest. Preference holder will expect preference dividend. Equity shareholder will expect equity dividend. So we are finding out the cost. Cost means an expectation. Cost means an expectation. Okay, so cost of a debt, KD is equal to I into 1 minus T divided by NP. Why I into 1 minus T divided by NP? Because debenture holder will expect interest on his investment, and company can save tax on payment of interest. So that's why the net cost will be I into 1 minus T. I'm not taking example, I'm not giving a detailed explanation. So right now KD is equal to I into 1 minus T divided by NP, and if it is redeemable, KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Okay. And if it is an existing debt, instead of net proceeds, we take market value. Instead of NP, we take MV, that is market value. So this is a cost of a debt. And cost of a preference, KP. Cost of a preference, KP, is equal to PD divided by NP. This is for irredeemable. And if it is redeemable, then PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2. RV plus NP divided by 2. And if it is an existing preference share, we take market value instead of a net proceeds. When to take net proceeds and when to take market value, let us see. Okay. So I will be discussing in questions. The next, cost of equity, KE. KE, we have a 5 models. Dividend model. So dividend model, D1 divided by P naught. D1 means an expected dividend, P naught means a current market price. Instead of P naught, we take net proceeds. If it is a fresh issue, we take NP, net proceeds. And dividend growth model, K is equal to D1 by P naught plus G. D1 by P naught plus G. This is dividend growth model. So which method we should apply? If a growth rate is given in the question, then we should apply d1 divided by p naught plus g. Dividend growth model has to be applied. Earnings model, K is equal to E1 by P naught. Earnings growth model, E1 by P naught plus G, growth rate. E1 means expected earnings per share at the end of a year 1. We should take expectation. If in the question they have clearly mentioned the dividend paid means past, D naught. So we should not take D naught. Be careful, we should take D1. So most of the students will be doing a mistake. Instead of D1, they will be taking D naught. So cost means expectation. So that's why we should always take D1 or a E1. So K is equal to E1 by P naught plus G. So this is earnings growth model. So but in these four models, the popular one is K is equal to D1 by P naught plus G. Okay. And the last one, CAPM model. So this is very important. CAPM. At final level, you will be okay. So I think some of you might be joining CMA panel in next 2 months. So we are going to discuss the CAPM thoroughly again. So CAPM, capital asset pricing model, KE is equal to RF plus RM minus RF into beta. KE is equal to RF plus RM minus RF into beta. RF means a risk-free rate of a return. RM means a market return. Beta means a systematic risk. Beta is also called a systematic risk. They might ask you, okay, MCQ, multiple choice question. So beta means a systematic risk. RM means a market return. RF means a risk-free rate of a return. RM minus RF is a market risk premium. RM minus RF into beta is a security risk premium. Security risk premium. Next, weighted average cost of a capital. Okay, Varalakshmi, I will speed up. Weighted average cost of a capital. So, weighted average cost of a capital. So, generally we take these columns: source, amount, proportion, proportion into specific cost. Source, amount, proportion, and specific cost, proportion into specific cost. So, for calculating weighted average cost of capital, first step is to find out specific cost, and then so we have to find out weighted average cost of a capital. For finding out weighted average cost of capital, these are the columns: source, amount, proportion, specific cost, proportion into specific cost. Okay. So without wasting time, I'm going to start the problems. Going to start questions. Okay. So let me start questions. 1 minute. So we're going to discuss first question of a Super 50. First question of a Super 50. One minute. Meanwhile, you go through this 11th question, illustration number 11. So PDF was already shared. Illustration number 11. Go through this question. Illustration number 11. Go through this question. It's June 24 and December 23 question. Please go through this question. Meanwhile, you practice illustration number 11 and illustration number 11. In PDF, you will find two 13s. Second 13, you have to go through second 13. 11, 13, and 14. You go through 11, 13, and 14. If you have any doubt, I will explain you. Okay. Meanwhile, I will check what is the issue.